Hi, sorry about just now. I think I got cut, right? Because I think the time expired when I use up the 15 minutes. Not sure, but I think just now, I think you won't be able to see my face. Hopefully now you can see. I just want to go back on some points that I just mentioned about, especially the part on short selling, right? So I was doing some measurement, hand gesture during the narration in the part two, right? So I'm not sure whether you guys get the idea of short selling, right? As I was mentioning about when the market drop, right? Usually there's another way to earn money in the event where economic is going bad or the market is dropping. You can actually achieve a profit margin by doing a short sell, right? So what does it mean, right? Market going down, right? So what does it mean? You do a short sell means you actually buy, sell first, right? You sell at this price, let's say $10, right? Let's say $10 over here, right? So as the market start to drop, right, it dropped to $5. Okay, that's where you try to buy back. Right? So you sell at this price, $10, and then you try to buy back at $5 as it drop after a while. Right? So which means what you can have achieve a profit margin of $5, right? Because you still buy low and sell high. Right? So this is what we call short sell, where you basically sell at the point where actually you don't own anything. Right? That's something like borrowing. Right? So you borrow first, then later on you try to buy back at the end of the closing time, right? So you have to do that because if the market close without you having to close the transactions, without you having to buy something, there's nothing that you can sell. So the stock exchange will force sell or force buy for you, right? And they usually buy at a very lousy price, right? So you just have to take whatever buying price that they have achieved for you, right? So there's a risk over there. Right, now let's take a look at this another scenario where you try to use derivative to hedge certain risks, right? So like in this case, a European investor, right? Somebody, an investor in Europe, right? And they want to buy another cross-continent like American shares, right? Over at America. This is quite common. Just like sometimes in Singapore, now we can trade a US market, right? While we are in Singapore, we can actually buy US shares, right? We can also trade on US. So, but there's certain risks involved. Right? Other than you have actually will be experienced two risks, right? It's not only just the fluctuation of your share, the US shares, but there's also another consideration is the exchange rate, right? Because you are using Sing dollar to buy US stock in US dollar, and then when you take profit, you also going to exchange from US dollar to convert to Sing dollar. So there is always this uh, double risk, right? Other than the stock share price and also the risk of exchange rate that might turn against you. So there's these two risks. So in order to hedge one of these risks, right, the investor can actually use a currency, invest or purchase a currency future derivatives, right, to lock at a fixed exchange rate, right, so that they only have to worry about the US share price. They only have to worry about share price, and they are safe on the exchange, right? Whenever they have to convert Sing dollar to US dollar or euro to US dollars, right? So vice versa. Okay, so at least they hedge on one of the variable. Okay, let's take a look at these questions. Right, what is the cost of 100 shares for Gifty? Buying these Gifty stocks, and there's a bid ask price, okay, of this $31.25 and $32, right? So one is the bid and this is the asking price, or you can say this is the selling and the buying price, right, of the stock exchange, right? And now we're considering this $15 commission for every transaction you do, right? So the question is asking what is the cost, right, of getting 100 shares. So now 100 shares. So which price are we looking at? Is it this price or this price? Right? Naturally, is these are listed price. This is the listed price. So when you buy, you actually have to pay at this price. You can't be paying this price, right? Because if you buy at this price, then you might as well immediately sell it back to the stock exchange, right? Imagine you buy low and sell high already, right? The stock exchange surely losing money. So in this sense, the bid ask is actually the sell and buying price, right? Bid ask is actually a sell and buying price. So when you were supposed to buy, you actually buy at the higher value, right? Higher value. So in this case, how much? 100. How much will it cost you? It's 100 times $32, which is 32 times 100 plus the commissions. So the overall cost for getting this 100 shares is actually $3,015. So A is the right answer. Right? I hope you get that. Okay. So, well, we have come to the end of these chapters. So, just like to highlight the three important points to take note. Whole idea is now we have introduced derivative. So derivative is actually a sales agreement or contract, right, that talk about trying to secure some underlying assets price value. So, right, where you use this financial instrument to hedge certain risks, right? And we also want to introduce that there's four derivatives that we'll be looking at in particular. That's the forward, the future, the swap, and the options. Okay, so this we will continue to cover in the following chapters. The two very important people that in this full scenario is one is the hedger and the other one is the speculator. The hedger will basically be the one who try to manage the uncertainty. They want to reduce the risk, financial risk that they have. They are very keen to fix the price of the underlying assets that they're going to acquire, right, or sell. Whereas the speculators, these are the gambler, they want to potentially profit from it. And I can tell you, the speculators are the ones who are not interested in the underlying assets. They are not actually not sometimes not very keen in holding on to some of these uh, assets also, right? So anyway, we'll dwell on this again in subsequent lecture. So these are the 3 points that I would like you guys to ponder upon and then think about it, right? So thank you very much for all your time, attentions. Thank you.